Welcome to today's webinar on the markets, where we're going to talk about tariffs. We're going to talk about wars, talk about the new economy, and really kind of what should you do with your portfolio. And this is really kind of coming today. First, I want to apologize. My co-host couldn't make it with me, so it's going to be a little more boring. You get just me. But the purpose of today's conversation is really about what should you be thinking about. We've gotten a number of calls here in the office around, hey, are things okay? Are they not okay? I've seen the market do a little bit more become a little more volatile. I hear all this conversation in the news, kind of what should I be aware of? And so that's what today's conversation is all about. Really, there is nothing here that is going to tell you that we need to hurry up and change. We need to sound an alarm bell or any of that kind of stuff. So if you're looking for some sensational kind of news, that is not going to happen, unfortunately. If that was your desire, that's unfortunate. Instead, today, we're going to really break down a couple of different things. The first one is I'd like to start by kind of trying to separate news and markets. So what happens is many times we hear things in the news and it triggers a couple of different reactions. The first one is that we think that if one thing is going bad in one area, that it must mean things are going to go bad in other areas. So we hear bad news or things that we perceive to be bad news, and we think that surely that's going to affect our investments. And the investments are something that we think we can control. And so it makes me nervous about what that might mean. So what I'd like to do is I'd like to kind of talk through a couple of those examples or what I mean by that. The first one is it's kind of funny. Let's talk a little bit about the news. So I can tell you that we have the exact same conversations with people, whether they are liberal or they are conservative, whether they voted for President Trump or they voted for Kamala Harris. It's just timing is a little bit different. And when the calls come in, I can guarantee you, I can tell you what news you're watching. What happens is all of us tend to shift to what we call your confirmation bias. And so confirmation bias, what do I mean by that? We tend to listen and look for things that are like us and things that we agree with. And so what happens is when I start doing that, it starts to create a loop where I now start to reinforce what those thoughts were, and it magnifies what those effects are. So recently what we've seen confirmation bias happening for those folks that are not necessarily pro-Trump, that they're listening to getting their news from places like CNN or maybe some of the more liberal news outlets, and they're calling and they're saying, oh my gosh, the world's falling apart. Now, I said I get the same calls from people if they're conservative. We were getting those same calls back in October, November of last year when they were watching Fox or whatever conservative news outlet they were watching that was saying that the Democrats are going to ruin everything. And so the reason I bring that up is not to say you shouldn't listen to the news or not to say that you shouldn't have your political views, but it's to point out that the best way to do that is to try to make sure that you're getting a balanced approach. And so let's talk about that a little bit and what I mean by a balanced approach. Because what happens is the second bias comes in, and that's what we're experiencing a little bit now, is what's called recency bias. And so recency bias, and I promise we'll get to the part where this affects your markets and what we're doing with your money. But I like to set the stage because what we see in recency bias is what happened most recent carries far more weight than what happened in the past. And I found this diagram or this picture on the web that I'd kind of like to share with you, which as we go through this, just as an aside, if you're not familiar with Zoom or how to do a webinar on Zoom, down at the bottom of your screen, you should have a couple of buttons. It says like raise hand, chat, Q&A. If you raise your hand or if you click chat, you can type in any questions that you might have, and I'll answer those either throughout the conversation today or we'll do it after the webinar is done. But feel free to ask questions there. Let me share though. Let's go back here. Let me share this screen with you. And this kind of just illustrates, and this happens to come from an investment place. It talks about what recency bias is. And what happens is if you look at this kind of diagram here, you'll notice that we have big returns over a 5-year period. However, we have a short-term downturn, and then all of a sudden people start questioning, should I continue to invest or what should I do here? And I think that's illustrated really well if we look at some history on investments. So if I, again, just do a Google search and pull up the S&P 500 chart, you'll notice here, this shows the last 1 month of investment returns. Now, no, your portfolios, if we're managing them at least, your portfolios are not all invested in the S&P 500. I'm just using this as the example because it's pretty simple and pretty easy. Everybody understands the S&P. And so if you look at this and you say, all right, in the last month, how have my investments done? Well, you'll notice right here, it gives us the numbers. And in the last month, your portfolio, if it was only invested in the S&P, would be down 8%. So recency bias would say, oh my goodness, the market's going down. Things are not good. I need to make some changes. Well, if I extend this out and say, well, what's it look like for 6 months? Well, now instead of being down 8% over 6 months, I'm only down 1%. And then if I extend that out to another year to date number, now I'm down 3.8. Like, man, this is exactly what I'm talking about. The market is falling apart. But what happens when I go to 1 year? If I go to 1 year, you'll notice that in the past year, you're actually up still 9%. Even after the last dip that showed that you were down, your portfolio, if it was all S&P 500, would still be up 9% in the past year. So what happens is when people start getting a little bit nervous about where things are going, there's a couple of things that we start to look at. One, what is the confirmation bias that they're taking part in? So right now, one of those confirmation biases, we talked about the negative side, right? The negative side of, hey, if I believe that the things that the current administration is doing is wrong, and I'm watching news that's telling me that's wrong, and I continue to build that case, I can distort that view to the negative more than it's warranted. When I combine that with this recency bias, all of a sudden I can start saying, see, I told you that those things are wrong. The world's falling apart. We got to hurry up and make some changes. If I do that on the flip side, and instead of listening to the opposite view of the current administration, if I start listening to the pro-current administration, all of a sudden I can get this false sense of security building this up, saying, man, everything's going to be great. We're on the right track because I continue to go to that confirmation bias. So I want to start there and just say, let's try to leave some of those things at the door, because most of the things that we're hearing about in the news are not going to affect your portfolio. Most of the things that you're hearing about are things that are meant to get headlines and get clicks more than they are things that are going to be substantive to what your portfolio looks like. And so let's unwrap that a little bit. The one thing that I try to keep in mind is that the newspaper or the news is not there to give you the news anymore. I just read an article that talked about how ever since we went to 24-hour news cycles where the news is on 24 hours a day, the CNNs and the Fox Newses and those types of places, in order for them to stay in business, they have to be running something that's sensational 24 hours a day. So you never will see that the market declined a little bit today, or the market increased a little bit today. It's always the market crashed or the market soared. And so when you start thinking about that, it can start to alter the way that we see things. And especially if we're looking at it in a small, short time period, it can really distort what that looks like. So we need to extend that viewpoint and realize that most of the things that we're hearing about are not going to have an effect on your portfolio. So let's shift gears a little bit and let's start talking some about the things that are going on right now that we think might have an effect, and kind of what is it that we're doing to manage portfolios. So first, let's talk a little bit about all the conversation around tariffs. Tariffs are definitely something that have an effect on a portfolio. But if we go back and look again historically and kind of broaden the conversation and say, what are we really talking about here? I think that we'll see that there's not probably as much of a risk here as what we've seen in other things, and as much of a risk as what's being portrayed. So if you look at history, tariffs have been around since our country has been around. George Washington was the first to introduce tariffs. And the reason for tariffs, there's three. The first one, it's to grow government revenues. And when we talk about growing government revenues, it's a way for the U.S. to just generate some additional cash. Now, it's also effective for protecting domestic production. So trying to get things to be made in the U.S. or whatever country is implementing the tariff. And countries all around the world have tariffs. This isn't something unique to the U.S. And the third one is it's used as a negotiation tactic to reach reciprocal trade agreements. And again, I pulled that off of a couple of historical research sites and just said, hey, what are tariffs for? What's the history of them, and why have we had them? So if we use that as the backdrop, and say, okay, what does that mean for us? It means we're trying to level the playing field. It means we're trying to increase domestic production, which typically would lead to domestic jobs. It typically means that we're trying to negotiate. So those things being said, that's not all negative stuff. There is negative to tariffs. The negative is that it can increase pricing. The negative is that it can be inflationary. The negative is that it can reduce economic output and be a barrier or a constraint to how much we're growing. But tariffs in and of themselves are not new. Tariffs in and of themselves are not necessarily good or bad because there are pros and cons to them. Our opinion, however, is that tariffs disrupt the free market economy. So when I say free market economy, what I mean by that is a free market economy is one that allows you to have supply and demand kind of work itself out. So a free market economy would say we don't need governmental involvement, because if I want to sell something and somebody wants to buy it, it'll find a natural price point. I'll use an example that's not economic driven, but somewhat is. I'll use the ban on smoking indoors. Now, you can argue that the ban on smoking indoors was a good thing. It's good for your health and all that kind of stuff. But in a free market economy, what would happen is it's my restaurant. I can choose whether or not I want to allow smoking indoors. And what a free market economy would do is it would say those people that do not want smoking indoors will choose not to go to that restaurant. The people that do want to smoke indoors will choose to go there. And then that restaurant will either make money or they will lose money because people will decide where they want to go for dinner. And you can apply that to virtually any part of our economy. Apply it to electric vehicles. You can say the government, if you look back over the last number of years, the government has put a lot of subsidy into electric vehicles. Well, you could say that that's not allowing the free market economy to work, because if people wanted those, they would find a price point in which they would buy them. If they didn't want them, they wouldn't be in existence. So I use that as a way to kind of say, with tariffs, the thing that we would be opposed to with tariffs that we're not fans of is that it disrupts that free market economy. And so when we start thinking about how does that play out, it's kind of like a balloon that's got air in it. If you squeeze one end of it, the air in that balloon has to go somewhere else, and there's an effect to that. That's what's going to happen with tariffs. We don't know for sure what that effect is going to be. If we look at what President Trump has said or what his administration has said, we can get a glimpse into what they think, what they would like the effects to be. And what we've seen is that they would like the effects to be more equal trade, a way that we can trade evenly with our trading partners. They would like a way for us to have more production being done in the U.S. versus outside of the U.S. They would look for ways that they can control the amount of drugs and things that are being shipped in through some of these tariffs and by applying pressure to other economies. When I look at some of those desired outcomes, those sound kind of good to me personally. And I think that economically, over the long run, they could be good for us. What I'm not sure about is that that's the outcome we're going to actually get, right? And so that's where some of the concern comes in. And so what I'd like to do is talk through kind of the things that we see as things to consider. And then at the end of this, I'll tell you kind of what we've done and what we're continuing to do with your portfolio. So tariffs, the concern there is not that the tariffs are there. The concern there is not that it's something new or that we don't know what the effects are going to be. We've got a lot of history with tariffs. We see how some of their pros and some of their cons. The concern is that what the desired result that we're going for won't be achieved and something else will happen. But we'll talk about how we're kind of managing that. Secondly, let's talk a little bit about this idea of all these wars that are going on in the world and how we're kind of a part of those, and that can seem pretty disarming or unsettling. And when I'm thinking about what it means to be unsettled, I'm thinking about how that then applies to my approach to how I invest my money. And what happens is when things are not settled and I'm uneasy, it makes me less willing to take risk in lots of other places in my life. And that's one of the things that's happening right now with some of the, I don't know if they're calling them wars or some of the skirmishes or whatever you want to call them around the world. And so when I think about that, it's kind of like when you're at home and let's say the washing machine goes out. Part of what goes through your mind is, okay, great, I just replaced the washing machine. When's the dryer going to go out? And then you're like, oh man, is the fridge going to go out? You get this kind of loop again where you start thinking about one thing is bad. How does that apply to other things? And that's a little bit where this conversation around war comes into play. Because it really is not going to be very significant to your portfolio. Now, if we ended up in a major war, it would be. But as I go through history and just think about, and I'm not a historian, but if I think about different presidents and different times in our history, I don't know that we've had a president that has not had some sort of conflict, not a modern day president, that has had some sort of conflict, some sort of major international upheaval. It's funny, as I was looking back, two presidents that I hear a lot of people talk very affectionately about were JFK and Ronald Reagan. And what I think is funny is that JFK was president when the Berlin Wall was built back in the early 60s. And Ronald Reagan was president when that wall was torn down in the early 80s. And so when you look at kind of that dichotomy and you say, if I was going to apply that to my investments, I would say, man, I should not be investing when JFK was president, and I totally should be investing when Ronald Reagan was. Well, I'm going to share with you, and I don't know, this again is one of those Google machine searches, but I'm going to share with you this chart that I've got that I ran across that I think is really pretty interesting. This is out at macrotrends.net. And what this will do is it'll show you the Dow Jones over different time periods. One of the things that you can look at is what did the Dow Jones do by president? So if I go down and I click on Kennedy. So if you look at President Kennedy, this was a pretty volatile time. We saw a huge downturn, but then all of a sudden we have this spike where it started growing again. And if you'll remember, during President Kennedy, not only did he have the whole Cuban Missile Crisis and our Cold War starting with Russia and that kind of stuff, he also had a civil rights movement that was taking place. Is when MLK had his I Have a Dream speech. And so there was a lot of things going on during that time period. Well, he was assassinated, so we don't know what would have happened had he stayed in office. But if I change this and say, okay, well, what happens when his successor came in and we saw Johnson, who just entered after a president was assassinated and had all of those things still going on? Well, if you'll notice, he continued to have a good bull market. The Dow Jones did really well, even following all of those things. It corrected, but by the time he left office, he was still up significantly from before he entered office. And so then I'm like, all right, well, what happened when Reagan was in office? Everybody talks about how he really helped us get the economy on track. And then I'm thinking about this Berlin Wall thing. He actually is finding peace. Mr. Gorbachev tear down that wall type of speech and all that kind of stuff. Well, when I click on Reagan, he actually had a fairly smooth ride, but not a whole lot of growth until he got to the second term. And now all of a sudden you get all this growth. And so the reason I point that out is these two presidents had major things that were going on. And I could pick on any one of these. I could, click on FDR or any of them and say, what was it like during their presidency? And as I would go through that, you could go through each one of them and say they had major things that were taking place. But when I look back today, the market actually didn't perform that poorly. And when I think about where the market is today, it actually is far superior, far better. If I go to this historical chart for the Dow Jones and look at it over 100-year history, I mean, you're way north of where you would have been during any one of those presidents, even though we had some of these volatile times throughout. So when I think about the things that are taking place around the world, none of them are to the level of World War I, II, Vietnam, Korea, those types of things. Could they be? Sure. But on the flip side, you could also look at that and say, we might be more secure today than we were 6 months ago or even a couple of months ago. Because if you look at the headlines, you'll see that Europe is arming itself like it hasn't in recent history. And so if anything, if our allies are arming themselves and getting stronger, even though we might be taking a change in that international conversation, you could argue that we're stronger because our allies are stronger. And some of that was initiated because of some of the turmoil that we've experienced in the last handful of weeks and months. So I don't know that when we look at the war piece, that's something we can say, hey, this is something we've got to make changes because we have all this turmoil going on in the world. So then let's talk a little bit about this whole federal cuts and Musk coming in with a hatchet and getting rid of all kinds of stuff inside of the federal government. And as we talk about that, I think it's good for us to recognize that those are major things, right? Anytime you have those kind of cuts, anytime you have that volume of people losing jobs, that's a pretty big deal. And anytime somebody personally loses a job, it's a huge deal. If I shift the perspective a little bit, what I really think we need to focus on for our portfolios and for the way that we manage our money is the federal government's spending deficit has to get fixed. It has to. If we do not figure out how to write our budget, that is the biggest risk, in my opinion. That is the biggest risk we are facing right now, long-term as a country, is the fact that we have had this deficit spending forever, that we now are trillions and trillions of dollars in debt, and it's not stopping. If we can't figure out how to get that fixed, that will be the biggest risk to our security, the biggest risk to our economics, the biggest risk across the board. And if you think about your own home, I don't know of anybody whose plan is that I'm going to spend more than I make indefinitely and do nothing about it. If anything, I'll make it worse because I'm going to continue to increase the volume with which I'm spending. And so when we look at these cuts, I can't argue whether I think they're the right cuts, the wrong cuts. I can't argue, do I think that I know better than anybody else about how they should be going about it. What I can say is that if we do not make some cuts, if we do not figure out how we get to a place with a balanced budget, that is the biggest risk to our national security, in my opinion. And that does apply to our investments. What we'll see is, and what we're continuing to see, is that the U.S. dollar is not the strength that it once was. It's not as stable as it once was. You've got a lot of conversations around, should we be going to digital currency? Should we get away from the U.S. dollar? Which are conversations have gone on for a long time. But if all of a sudden we get to a place where we have so much debt that we cannot repay it, or that our federal deficit spending is so great that we have to increase taxes on our own people so much that that does hurt our economy, that is a real risk. And so when I look at those cuts, I'm not sure, again, whether those are the right cuts or the wrong cuts. But what I do know is that those cuts need to be made. Some cuts need to be made. And so when we start to take all of that into consideration and start saying, okay, so we got these tariffs, are they good or bad? We've got war, which in our opinion war is always a significant issue, but is not significant to the point where it's going to affect our portfolios. We've got this federal cutting of jobs that's going on, which is going to have some effect. But our encouragement first would be look past the headline to what's actually taking place. And that's how we manage your portfolio. So we had, over the course of the last, I don't know, probably dating back to September, October, we made some changes to portfolios. And so I guess the first step is, whether we're managing your portfolio or somebody else's, you've got to make sure that you're diversified. None of this has a whole lot of effect if you've got your money spread out into a lot of different places. We looked at the S&P 500 chart a couple minutes ago, showed a lot of volatility. But if we would have focused on how do we diversify that volatility, you would have ended up in a much more smooth, much less jagged type of a return. So we've got to be diversified. One of the things that I encourage people to do is to look at what is the compound rate of my portfolio, not just the average rate of my portfolio. So let me share this real quick. And this is one of those charts that that kind of just surprises me all the time or blows me away. This just shows what is the hypothetical return of two different investments. This orange line you'll see has a high of 25%, low of negative 15. And it just goes back and forth, high of 25, low of 15. The green line has high of 15, low of negative 5. So what happens is, if you look at those and you just do a mathematical average, what the mathematical average will tell you is that both of those portfolios gave you a 5% average rate of return. The problem is that that's not your compound rate of return. If we would have compounded this and said, let's put $1 in and what's it worth at the end and all that kind of stuff, what happens is this next number, this standard deviation number, means a lot. And what happens is, if you take more risk and get the same average rate of return, you will end up with a compounded rate of only 27.4% over this hypothetical period. If you lower your standard deviation, so standard deviation just means how much variance do I have in those highs and the lows. If I average lower my standard deviation, my compound return, what do I actually get, ends up being 42.5%. 27% versus 42. Compound return matters. How do I smooth out my portfolio returns matters. And so when we build a portfolio, that's what we start looking to build. We look to say, how do we make sure that we are taking appropriate risk, but we're taking appropriate risk in a way that is going to help us get to a higher compound rate of return. And so as we managed the portfolio last fall, we started seeing a lot of things happening that were not some of the things that we're talking about today. Tariffs weren't necessarily in the mix. We had a lot of uncertainty around presidential elections and those things, but really what we started looking at was what's going on fundamentally inside of our investments. And what we found was that in the U.S., those stocks were highly valued. They were pretty expensive in our opinion. Just to give you a quick rundown, the way that we measure that is through what's called earnings per share. If you think about earnings per share, it's a ratio. So earnings over share. I think about it like if we go to Target and you're going to buy toilet paper. You don't necessarily just pick one of the toilet paper rolls or packages off the shelf. Many times you look and say, well, wait a minute, how much am I paying per roll, right? I don't care. I might be paying more money over here because I'm getting more rolls, but if my my dollar per roll is lower, that's the better deal. We can do the same thing with stocks. We can look at stocks and say, how much am I paying for $1 of their earnings? And that's your earnings per share instead of dollar per roll in toilet paper. So when you think about that, we can then look and say, I know that I should typically pay somewhere between $15 and $20 per share for stocks in the U.S. In the fall, that number was up almost to 30. So if I know that it should be between $15 and $20 per earning, but it's up close to 30, that tells me it's expensive. So consequently, what happened was back in the fall, we started adjusting the portfolio because of that. When we looked internationally earnings per shares were actually lower. I mean, it was at a value really. And so what we did is we were overweight U.S. stocks leading up to the fall. we shifted away from US and went to a neutral weight. So overweight neutral. The way I like to think about that is we build a portfolio, and neutral means here's about how much we think we should have in US stocks, as an example. To overweight that says we're going to take it from here and we're going to buy more of it. To underweight it says we should be here, but instead of being at this level, we're going to have less in the portfolio than what we intended. So going into the fall, we had more U.S. stock than we normally would, and we were underweight, had less in international. So we shifted from U.S. to international. Now, this doesn't always happen, but for us, that was a good move. If you look at your statements when you get them, international stocks have really done quite well this entire beginning part of the year. The other thing we did is we bought into what are called hedged equities. So hedged equities, what I like to break things down into what are the words. So hedge means, I think about what a hedge is. You can have a hedge in front of your house, keeps the wind and snow and things from battering the house. You can hear people sometimes say, I'm going to hedge my bet, make sure that I don't win, that I'm going to kind of take a bet against another way so that if I don't win, I don't lose at all. Same thing happens with this. It's a way to protect your investment. Equity means that it's stock or that it's ownership in companies. So what hedged equities does is it protects us in case the stock market were to go down. We put some dollars there. Another thing that we did is we shifted portfolios into real assets. I know sometimes clients will ask us, hey, should I be investing in gold, or should I be investing in precious metals, or what should I be investing in? And from our perspective, when you see inflation that's fairly high, you see uncertainty in some of the financial markets, some volatility coming, real assets sometimes can provide a buffer or a protection against markets going down. It's a diversifier, if nothing else. And so we added some money to real assets. And then the last thing we did is we shifted some of your investments that are in bonds, kind of your traditional bond funds, into what are called dynamic bonds. Dynamic bonds give the portfolio manager more freedom and flexibility to kind of move with markets as interest rates change. That's the dynamic part of that equation, or of that name. And so when we look at that, we anticipate interest rates to be volatile. And not volatile like terribly, but we do anticipate interest rates to be moving up and down. So we made a shift into those dynamic bonds. So when we look at where the portfolio is, all of those changes that we made, none of them had anything to do with tariffs. None of them had anything to do with wars that are going on in the broader world. None of them had to do with cutting at the federal government level. All of them had to do with fundamentals that are going on inside of the investment world or inside of the markets that we're seeing. The reason I mention that is all of the things that we talked about at the beginning part of this webinar were all things that I like to think of kind of like when you go to see a magician or go to see some sort of show. You've got all this noise, all these movements that they're doing out here to take your attention off of what's actually happening here and how they got the quarter to get behind your ear. And so what happens is a lot of times we can start focusing on all of the things that are on the periphery. Those things are serious. They're real. Those things can make us very nervous or not. Sometimes they make us overly confident, but they're noise when it comes to investments. Not saying that they're not important. They're very important. But when it comes to how you manage your money, they just don't carry that much weight. And so the focus has to be on what is actually going on with the investments and how do we make wise decisions with those versus allowing some of the other things that are not as important to carry that much weight. So to kind of wrap up, if you have questions, again, down at the bottom of your screen, you'll see a couple of things. You can raise your hand. You can type in the chat. Please type them in there. I'm here to answer those questions. But at the end of the day, what we're finding is the move that we've had, first of all, the move we've had here in the last few weeks or a couple of months isn't even enough to register on, like we're not in a bear market. We're not huge things terribly falling apart. None of that. We've had some volatility. Sometimes that's over exaggerated because we've had such a good run the last couple of years that we forget that things go down as well. We also have a lot of negative press that's being put out there in regards to some of the things that are some of the changes that are taking place, which can make it seem like things are even worse. But right now, there's no reason to make any drastic changes. We have made proactive changes to the portfolio based upon what we see happening in the fundamentals of investments. Those changes, though, are all geared around how do we help you build a good, solid compound rate of return, trying to eliminate some of the volatility while still taking advantage of some of the market trends that we're seeing. So hopefully that's helpful. That gives you a little bit of perspective. Hopefully also it'll help you to realize that as things are coming out, most of the things you're going to hear are going to be noise instead of substance when it applies to how you should be managing your portfolio and what that should look like. So that's the end of our kind of prepared remarks. I'm going to leave this open for a couple of minutes just to see if anybody has any questions, because I'd love to answer them. Typically Katie, my co-host for the podcast, would be on with me, and we'd be, able to have some chatter back and forth. And so I apologize for the monotone and the just kind of the monologue, I guess. But if you haven't subscribed to our podcast, please do. We release a new podcast episode every 2 weeks. If you're not familiar with some of the tax work that we're doing, know that we also are now doing some more advanced tax preparation. So you'll notice that our name now is PVWP Wealth and Tax Advisors. The tax advisory part of our business is all around how do you make proactive decisions with your taxes. Just a couple of minutes on that, and this is part of our shameless plug, I guess. But what we found in the industry is that most accountants don't do a really good job of helping clients be proactive. And so the analogy I like to use is, imagine that you wanted to go on a road trip. I'll call out, I see my mom's dialed in for the webinar, so I'll call her out. Her and Al are heading cross country down to Florida right now, so this is kind of appropriate for their road trip. Imagine you're going to go on that road trip, and before you left, you did not decide or where you were going to go. So you had no idea what the destination was. Then you wrapped your windshield in wrapping paper so you could not see out the front. And the only decision you made was based on what was cheapest for you in that moment. That, in our opinion, is how most accountants have approached their accounting business and the way that they help people. And let me kind of walk through that. So the first one is, ask yourself, when's the last time your accountant asked you what your long-term goals were? How can they help you make good, wise decisions if they're not focused on where you want to get to? Most accountants don't do that. I think some of it comes down to kind of when I talk about having your windshield wrapped in wrapping paper. I think about that kind of like you can only then look out the rearview mirror, right? Because that's all that you have to look at, because you can't see out the front. But that's really what an accountant is designed to do. If you think about the name accountant, to account for what already took place. Well, if it's already taken place, I certainly can't be proactive in making changes to save on my tax dollars. And if I'm not looking out the front windshield, I'm probably not necessarily getting to where I want to get to, because I can't see where I'm going. I don't even know where I'm going. And then when I finally add to that the fact that every decision is made based on what saves me money today, probably isn't the best way for me to make sure that I'm saving the most that I can over the life of my investment, over the life of me, to be quite frank. And so what I mean by that is, imagine that you're on that road trip and you pulled up to the gas pump and diesel was cheaper than gas. The car ain't going to run real well if you put diesel in it, right? But you save money at the moment. Similar to your accountant that sits down and says, hey, if you put money into an IRA this year, you'll save this much on your taxes this year. But they haven't looked at what does that mean long term, and will you save money in the long term? So when you think about that from a tax perspective, the key is, how do we make sure that we have proactive tax advice? We're looking to lower our tax burden throughout the life of our investment. Those kinds of things. So I had a question that came in regarding really some questions around, hey, if the wealthy people maybe aren't paying their fair share, are we going to lower our deficit and that kind of stuff? and really that starts going to politics around what does fair share mean? What does tax mean? What does, because we have those conversations too. We have some that are telling us, hey, we feel like the wealthy aren't paying their fair share. But at the same time, I've got people that are saying, hey, what about this proposal that says anybody who makes less than $150,000 a year will pay zero tax, which is a proposal that's out there right now. And I think the key is that we have to find a way that we have the right tax that's coming in the right ways to help reduce to reduce our deficit. Whether that's I'm wealthy, I don't have a lot of money, or I do have a lot of money, it really comes down to how do we make sure that it's fair across the board. And it has to be done in a wise way. But we honestly, like, you can have just as many arguments around wealthy are not paying their tax versus people that are not wealthy aren't paying their tax. And it really comes down to what is fact, and they're probably both true. It's just which megaphone is saying which message. And so, from our perspective, the keys to making sure that you're taken care of: diversified portfolio, being proactive based on the actual fundamentals that are going on inside of the economy. Don't focus on the noise. Don't focus on the things that aren't going to have a fundamental change to how your portfolio is going to react. Focus only on those things that will have a real effect. Well, thank you. I've enjoyed having you as part of this webinar. Hopefully there was something of value that you're able to pick up. Please head to our website, PVWP, for all things Prairie View. You can pick up podcast episodes and white papers. We will be emailing out after this a recording of this, and we also have written a white paper on what to do in a bear market. Again, this isn't a bear market, but maybe it'll help to shed some light on how you make some good decisions. So thank you so much, and I hope you have a good day. Be well.